How to place a call in 3 steps. Stay tuned. You really don't want to miss this one. Hey guys, today I'm going to be showing you how to place a call on your Robinhood account. A lot of people have been asking me about this, and a lot of people actually don't know how to place this call. It's been a huge resource in how to increase our portfolio. However, it is risky. So I'm going to walk you through the steps real quick on Robinhood. But remember guys, you probably just want to try it out one time and then go from there. Pick up one contract, and I'm gonna make it real easy because I see a lot of videos on YouTube that kind of explain it. I'm gonna give you the meats and bones of it, but some people make it real difficult where at the end you're still like, what? I'm gonna give you the important points, and then we're gonna move from there. Okay? So with that, let me go ahead and go to my Robinhood account. I'm gonna go into INTC, which is Intel, guys. I've been buying a lot of Intel. I told you last week, and I keep putting it out there on our Twitter account, at Investing OG, that Intel is going to hit a new high. It's heading that way because of the shortage and because of Biden's plan to help these companies. I'm buying a lot of Marvell, I'm buying a lot of Intel, and I'm buying a lot of AMD. Those 3 companies, that's what I'm buying. With that, guys, if you go to the INTC, you go to the calls. Okay, so I'm going to explain it real brief to you. First of all, you're going to go to view all options. Okay, so you're going to get view all options. Currently, share price, it'll tell you here, is at $62. Okay, any of these calls that you see here below the 62, that means you're in the money. That means you're within the $62. Okay, and I'm going to explain to you what's the difference and what happens and what to look for. Okay. So, as you can tell, if you look at this number and you look at these numbers, these are your premiums, guys. Okay? As you go up and you go further away from in the money, which is this is 62, this is in the money. As you go to 62, 62.50, 63, 64, you could go all the way up to 90. It gets really cheap, right? Okay. There's a reason why it gets really cheap. So I'm going to give you a simple example. We're going to click on this, for example, this $63 call, which is 54 cents, okay? But it's 54 cents times 100. So if I were to buy this call here, if I were to buy that call there, and I say long call, okay, continue, and if I do one contract, it's $54 for that contract, okay? This contract expires on February 19th. So that means that the price of Intel has to go up from where it's at now, $62, as long as it goes up, okay? At the end of the day, I don't want to get you guys confused. I keep one thing in mind. This is how I learn. I'm going to pass it on to you. Buy low, sell high. If you think that Intel will go higher than $62, then you can buy a call that's up here. Okay? If you think it's going to go lower, you shouldn't be buying these. You should be buying puts, but we're not talking about puts today. We're talking about calls. Okay? That's all I do. I have a positive mindset. I look for calls. I look for companies that are low that I think are going to go high. That's the way I think. That's just me. You could be a lot different. So, getting back to this example. 54, right? 54. So this is your premium. This is what you're going to pay. Okay, so say for example, I like this one. It's February 19, but I don't like the date because this means February 19, this means that it has to go up by February 19th. Otherwise, my contract expires and it becomes worthless. So say for example, I buy a contract at 62 share price, and it ends up falling to $50. And today is February 18th. So that means by tomorrow it has to go up above 62, but it's not going to get there because we only have 1 day left. Not unless the market explodes. So what's going to happen? You're going to lose that money. So what's going to happen? You're going to lose this money. You're going to lose this price. You're going to lose these $54. That's all you're going to lose. You're not going to lose more than $54. Now, if you want to help yourself out, I would suggest to you to always pick an expiration date that is further out. So if you're looking at February 19th, February 26th, I can say, for example, I can go 2 months out, right? I'll go to April 16th, okay? Feel more secure, I give myself more time, I'll do that. February 16th, now I'm looking at the calls. Now let's go back to the $65 call. Again, same one, but I want you guys to look at something. We're gonna get one contract and look at the price, how much it changes, okay? It goes to $289, okay? This same amount is your premium, but now right, you get $289. So now the premium has gone up, okay? It goes up because you're giving yourself more time. You're giving yourself more leverage. You're able to extend the time out. You don't have to be worried about it's going to be the 19th this week. It's going to expire. I can lose my money. You are paying more, but you're helping yourself out at the same time. Now, if you think that this stock is going to go up on, say for example, you heard some great news today, and you think in the next day it'll go up, then you shouldn't be too worried about the expiration date. In that case, I'll go back to the first example. I'll get it at February 19th. I have 5 days, but I think it's going up tomorrow. I pay less because that same call, $65, is only costing me, here we go, 65. Say I add that, that's only costing me, do this, I'm gonna go back to the $65 call, February 19th. And that call, long call, continue, we do one, right? That's only costing me $19. But it has to be done by the 19th, right? So that's the difference. In one, you're having less time, but you think it's gonna go up really quick, so you can pay less. And in the other, you have more time and you give yourself more time to breathe, okay? Now, that's one thing. The second very important thing is whenever you do any of these calls, I'm going to show you the same example so we won't be jumping back and forth, okay? There's something very important about this stuff here. I want you guys to keep in mind the Greeks, okay? What are the Greeks? The Greeks are basically telling you how much will your contract change by every dollar that it goes up, okay? Making this as easy as possible, guys. So in this contract, which was a $65 contract that's ending on February 19th, that's the same example that we just touched. You see this number? It's 0.13, but you're multiplying that times 100, right? This delta right here, right? So when you multiply that times 100, that's $13.72. Okay? That means for every dollar that it goes up, so say for example you bought it at 60, now it's at 62, it went up $2, it goes up $13 per contract. You bought one contract, so it'll be 13 and 13, 26. Now you're up $26, okay? Let's go back to the same one, but back to the same date, April 16th, and we're gonna go back to the same call. I'm just doing the same one so you guys could see the difference. In this case, the same call, but we're pushing it out to April 16th. We have a delta here at 39.39. So that means 0.39 times 100, because it's 100 shares in a contract, okay? Then this would be $39 for every dollar. So if it went up $2, it would be 39 times 2. So almost $80, okay? 78 to be exact. You see the difference? You're paying more, but you're making more. You get it? So you're paying a little bit more, but you're making more. So what if it goes up $5, $10? You know, it can't do that. It's done that before. You make more money, okay? So this is the easiest way. Another thing that I want you to keep in mind that's very important as well is the theta. Okay, this one right here, the theta. This is like think about it as it eating up your contract on a daily basis. It's like the how can I compare it to something? It's like basically it will eat a tiny portion of your contract the longer it goes. And if you notice that on the one that you paid more for, you have a 0.028 data negative, right? Because it's negative because it's taking away a tiny piece. It's kind of like Pac-Man. It's eating at it slowly, slowly, slowly. When I do a call, if my call that day goes up, for some reason it gets upgraded, the stock got upgraded, it took off $5-10, I'll take my profits and run and flip it to the next one, guys. Okay, it's very crucial sometimes you do that, because if it happens to fall again and it takes another week, another month to get back to that price, the data will be eating away at your contract. So by the time it reaches back, you're actually going to need it to go higher, because it has already ate portion of your contract, right? So you guys get it, right? The theta will eat a little bit away, just tiny bit every day, okay? So when you do want to purchase, when you want to see this theta is as low as possible. So I'm going to give you the same example. We did the April 16th. This is the theta, 0.02. We're going to go back to the same one that we did earlier, which was February 19th, 65. Going to the same call. We're going to the Greeks. You see that? The theta is higher. It eats away at your contract faster. Usually when they're out of them, like further out, you push them out further out in terms of the date, it usually has a lower theta and it'll eat very slow. Okay? Those are the main things that I want you guys to consider. The last thing that I would probably say is very important is look at this open interest and look at the volatility and the volume. Okay? This will tell you how many people are in this play here. This is the volume. You know, you can have 51,000 people and 51,000 people have one contract a piece, or they can have 100 contracts. Okay, so look at those numbers just to make sure that people are actually buying this call as well. So you want to keep that in mind. Okay, so we said the delta is very important, the theta is very important, and we said the open interest and volume are very important. So those are the three things that I would mainly tell you to keep in mind. Okay, so let me walk you through final step, final thing before we get out of here. We're going to decide on doing a $65 call. Okay, booyah. We do one contract. Okay, we do a limit price. Now the limit price is, you see this is the bid and ask price. So it automatically sets something on here. Now if you say, you know what, I think it's going to go down and I want to pick it up a little cheaper, you can go anywhere between 0.17 to 0.20. Actually, you can go lower than that if you want, 0.16. What's going to happen is that your order won't be filled until it reaches that number. So if it reaches that number, then it'll be filled. Okay? Or as well, this can be in hot demand and you say, you know what, I don't care. I want to put a price here that's a little bit higher. I'm going to put a 0.21 because I don't care. I want this contract because I know something's going to happen with this company. It's going to blow up. It's going to go up higher. I don't care about paying a little bit more right now because I just want to make sure I get it. Okay? So in this case, we leave it the way it is. We review the order. We say yes. We click submit and we're done. They charge us $19. That's all. Okay? Real simple, guys. Real simple. It doesn't take a genius. This is a way where you can expand your portfolio. You can make more money. You just have to be careful. So my suggestion to you, if you've never done this before, try it once. Keep an eye on it. You can go back and sell it at any point before. You don't have to wait for it to hit the 65. You don't. If you bought it at 62 and it went up to 63, you can sell it then if you want, and you're still making a profit. Okay, guys? I want you guys to understand that. Hopefully, this video has been of great information and great usefulness moving forward. I want to put you guys in those situations where you guys could benefit from this information, guys. Please, once again, if you found any of this information informative, please like and subscribe to this channel. Make sure you hit the notification bell. You click on the bell and you click on all, because that way every time we put out a video, you guys get it, and then you guys can get that information, put it to work, guys. We're gonna keep you updated all along the way. With that, guys, enjoy the rest of your day, and I'll see you on the next one.